Let's visit about the Chapter 11 problems. I've got our ebook open to the problems or Chapter 11 right here. And we'll go through about 5 of them together. Then I have an Excel file open also where we'll kind of just go and do the homework. So this chapter is about cash flow estimation and risk. And so many of the problems deal with calculating the cash flows of future projects, both the initial cash outlay and the future positive cash flows that will come back from investing in the project. So first one here, question 1, Talbot Industries is considering launching a new product. New manufacturing equipment will cost 17 million. Production and sales will require an initial 5 million investment in operating working capital, and the tax rate is 25%. So what is the initial investment outlay? And that one's pretty simple. It's just really just the 17 million plus the 5 million. I've got a little spreadsheet we can just go ahead and plug that into. So the equipment was 17 million and the net working capital was 5 million. So it's pretty simple one. That's about as easy as it gets. $22 million. Now they're asking some harder questions though on this particular question. So let's go back to that. And so the initial outlay, 22 million. The company spent and expensed $150,000 on research related to the new product last year. What's the initial investment outlay? So pretty common approach, right? Before we spend $22 million to buy equipment and launch a new product line, we probably better make sure that there's a market for the product, right? So we did some research to determine, will this product work? Maybe what should the pricing be? All kinds of stuff, right? So it's obviously something any company should do before launching a product, is doing some market research. They did that. They spent $150,000 last year. So the question then is, what is the initial investment outlay? And really, think of this as being a sunk cost. Okay, this is something that happened in the past that cannot change anything today. So we don't really do anything with this. This does not affect the $22 million. It's a sunk cost, happened in the past, cannot be undone, has no impact on what we're doing right now, other than just give us kind of that, should we do this or should we not do this type of a project. So sunk cost, I do not include sunk costs in the initial outlay. Then part C says, rather than build a new manufacturing facility, they plan to install the equipment in a building it owns but is now not using. The building could be sold for $1.5 million after tax and commissions. What is the initial outlay? So that deals with opportunity cost. And basically, we've got two choices for this empty building. We can sell it, or we can spend $22 million to put equipment in it and start making a product. Okay. So at this point, it looks like we're deciding to launch the product. We're going to spend $22 million and build a new product. However, by doing that, I'm giving up the opportunity to earn $1.5 million after tax. So that is going away. So because of that, I have to add this or charge it to the project. So I'm giving up the right to make this $1.5 million. That's the net after tax and commission. So really my initial outlay is 22 million plus the 1,500,000. It's the sum of the both, if that makes sense. So because that's an opportunity cost that we let go. And remember that that's something that doesn't show up in accounting. Like there is no journal entry for opportunity cost. But it does matter in finance when I'm really focusing on the cash. So I gave up the ability to earn 1.5 million. So I'm going to charge that against the project and say I better increase the cost of the project by that amount in order to do that. So $23.5 million would then be our initial project cost. Okay, so that was question 1. I think fairly straightforward, and just obviously the terminology of sunk cost and opportunity cost is important for this chapter. And then question 2 is about calculating cash flows. And before I do that, actually, I want to mention one more thing in question 1. They gave us the tax rate and we never used it. I just want to point that out. It's a pretty common approach in finance classes and accounting classes, is that they might give you information that you don't need, because this $1.5 million amount down here was already after tax and commission, so I never needed that 25%. I just wanted to point that out. Okay, now for question 2, the financial staff of Cairn Communications has identified the following information for the first year of the rollout of its new proposed service. So we're going to launch a new service line, and this is the projections of year 1 of the service line. And the question then is, what's the cash flow that we should expect after year 1 with the information given to us right here. So they've got the sales number, operating cost that does not include depreciation, the depreciation amount, and the interest expense amount, and tax is 25%. And we do need to know the tax number. The tax percent does matter for this one. So got this ready for us in Excel. And so it's just a matter of dropping in the various amounts. So $18 million worth of sales was given to us. $9 million worth of operating costs was given to us. And depreciation was 4. And actually I should enter that as a negative. So it's a negative number, and then depreciation was a negative number. Okay, so my operating income before tax is $5 million. Okay, so that's important. And oops, I forgot a line here. I got ahead of myself when I built this. So let me insert a row here. Then we need the tax number. And remember that tax is at 25%. Okay, so I'm going to take my tax number, and I'm actually going to make that be a negative, multiply by the before tax, and go times 0.25. So my tax is $1,250,000, and then my operating income before or after tax, let me add that one here, and we'll just sum these two together. Okay, is $3,750,000. So this is operating income after tax. I'm going to call it OI for operating income after tax. Then we add back depreciation, and I'll explain to you why we do this. So I'm going to just take that 4,000, add it back, 4 million I should say. Then my operating cash flow is the operating income after tax, add back depreciation. So the answer is $7,750,000. So let's think through why we did what we just did. So first I'm trying to figure out what's the taxable amount. Okay, so sales, operating costs, and depreciation. So keep in mind that depreciation itself is a non-tax expense. When you journalize depreciation, you debit depreciation expense and you credit accumulated depreciation. So you never hit the cash account for that. So sales minus operating costs minus depreciation gives you the operating income before tax. So that's what your tax stat is, the $5 million. 25% is $1,250,000. After tax is $3,750,000. But remember, in finance, I care about cash. And so I have to add back the non-cash expense of depreciation. And my true cash flow is $7,750,000. Okay, so I need depreciation to reduce the tax bill, but then I add it back once I get to my after-tax number. So the operating cash flow is $7,750,000. And that's why that's important. And one thing I want to point out about this question is they gave us the interest expense amount right here, and I never use that. Okay, I don't use interest expense when I do these calculations. We don't care about the financing at this point. We're going to use a weighted average cost of capital or some risk-adjusted cost, a percent cost, when we calculate NPV or IRR. That's all I need to know. I don't need to know the actual interest expense. So I just care about what's the operating cash flow, which is $7,750,000. Okay, question 3 is about salvage value. And with this one, it says here at Allen Airlines must liquidate some equipment that's being replaced. The equipment originally cost $12 million, and 75% of that has been depreciated. And then the tax rate is 25%. And what's the equipment's after-tax net salvage value? The after-tax net salvage value. So what we do is we just go back to the Excel, and I've got that right here. So the cost of the equipment was $12 million. and then we take out the depreciation. If you can recall, it was 75%. So I'm going to do minus 75% times 10 to the 12 million. And so that leaves $3 million. Okay, so the book value is $3 million. Now the question asks, though, it says, what's the equipment's after-tax net salvage value? And I think what I'm seeing in this question is there's something missing in the question. As I took a look at the answer sheet, it's like the answer sheet tells me that there is a sale price of $4 million. But the question doesn't say that. So assume with this question that there's a sale price of $4 million. So the equipment that they're liquidating, they're receiving a check for $4 million, basically. Okay, so they're going to receive $4 million back. So let's go and compute the gain. So the gain is the cash received, $4 million, minus the book value. So the gain's $1 million. Okay. Well, the tax on the gain, of course, would just be the tax rate. It'd be the 25% tax rate times the gain. So 25% times $1 million is $250. So the after-tax net salvage value, which is what the question was trying to get us to, is the cash received of $4 million minus the tax of $250. So that's $3,750,000. So remember that this is a new version of the book. They went from version 3 to version 4. And this obviously is just something that fell through the cracks when they did this question, because this question should have included a sale price of $4 million, and it did not. Okay, so we're going to go down to question 5. So I'm skipping question 4, by the way. So we'll go to question 5. And question 5, let me get to, back to the right place here. So here's question 5. And this one deals with depreciation methods. I really like this question because it helps us kind of think through some corporate policies that could be good or bad depending on your point of view. So it says here that Wendy's boss wants to use straight-line depreciation for a new expansion project because it said it would give him a higher net income in early years and give him a larger bonus. The project will last 4 years, requires $1,700,000 worth of equipment. The company could use either the straight line or the 3-year MACRS accelerated method. So remember that the 3-year MACRS is really 4 years. Under straight line, the cost of equipment to be depreciated evenly over 4 years. And then under MACRS, the percentages are right here. Appendix 11A, I don't really cover that, but that's where they talk about the various depreciation methods. But most problems should just give you the percentages within the problem. Cost of capital is 10, tax rate is 25%. So part A is what's the depreciation expense for each year under each method. And that was really pretty simple. I've already actually done that one. Let me get this entire thing on the screen for us here. There we go. Okay, so straight line is the $1,000,007 divided by 4 years, $425 per year. And I can add those up, and then you would see that it adds up to be $1,000,007, which is the cost. I'm going to add this one up too because that's also $1,000,007. So for MACRS, I just took the $1,000,007 times each year's percent. 33, 44, 14, and 0.07. But either way, I get to 1,700,000. So straight line, same number every year. MACRS is accelerated. The first 2 years have a lot of depreciation. The last 2 years have very little depreciation. Okay, so that was question A. Question B, which produces the higher NPV, and how much higher would it be? And that's where I've kind of added the other 2 columns here. So this right here supports part A. Part B is what these 2 things are for right here. So for part B, what we do is we take the difference between the 2. We just take the MACRS minus the straight line. So that's all it is. So in year 1, the difference is 141. In year 2, it's really big, it's 330, and then it grades off down. And notice that the sum of that equals 0. Okay, so the sum of actually, that's a bad formula. It should be like that. That equals 0. And the tax effect change is the next column. And that's just taking that difference, multiplying it by 0.25. But I want you to see that the sum of these two columns is 0 because the differences even out over the 4 years. Okay, so just want you guys to be aware of that. And so it's not the answer yet, because then what we have to do next is we have to use the NPV method to calculate the difference. And we always care about after tax. Okay, so keep that in mind. And with depreciation, the whole point of depreciation is it changes my tax bill, right? The more depreciation I take, the less tax I have to pay. So I'm saving $35,000 in year 1, $82,000 in year 2, but then I got to spend $43,000 in year 3 and $74,000 more in year 5 versus straight line. Okay, so but this just tells me what the tax effect is, which is the cash that I'm saving. So that's what I care about, is these tax effects. So I'm going to go back to the Toolkit Excel for Chapter 10. And what I want you to do is just kind of use this as an example to follow. So they told us in this problem the cost of capital is 10%. So let's go ahead and plug in the numbers. So these numbers right here are my cash flows for year 1, 2, 3, and 4. And then the cost of capital was 10%. So this already has a 10% cost of capital. And so in year 0, it's just nothing. There's nothing for me to put there. But then in year 1, I put in the net difference of 35,402.5. In year 2, it's 82,662.5. In year 3, it's a negative because I'll spend more cash in year 3. 43307.5, and in year 4 it's 74,757.5. Okay, and then what I want you to notice is this is my answer right here. Okay, so this NPV formula takes into account the 10% cost of capital, the 0 cash effect in year 0, but then year 1 all the various amounts. So basically, the difference is a positive 16,902. So what that means is if I use accelerated depreciation, my NPV is higher than straight line by 16,902. Okay, so that increases my NPV by using accelerated depreciation, and that's important. So let's think through then. Going back to the question, which one produces a higher NPV and how much higher would it be? Well, the answer with any question like this will always be MACRS. The accelerated method will always give you a higher NPV because you save cash on tax right away in years 1 and 2. And that will always outweigh the extra tax you pay in years 3 and 4. So if I can save money now, that's beneficial as opposed to later. Okay, and then how much higher would it be is the 16,902.26. In part C of the question, why might Wendy's boss prefer a straight line? And this is where I want to point out that this company's bonus plan is not good. Okay, this company's bonus plan is giving an incentive to a manager to use straight line depreciation as opposed to a modified accelerated depreciation when it comes to doing projects. And that means fewer projects will work. That means that's not the analysis we want going on for this particular company. So we need to maybe go back to corporate and say, the bonus plan should not include depreciation. It should be other items, but the depreciation should not be impacting the bonus plan, and that would really be the answer. So the manager has been incentivized to do one thing based on a bonus plan, but common sense says don't do that thing. Just produce more cash and make the company worth more. So that's where bonus plans need to be carefully written to make sure we're incentivizing people to do something that benefits the company as a whole and not just themselves and their personal paycheck. Okay, so that was question 5, and that's a good representative sample of the questions for chapter 11. Remember that in MindTap, you get a lot of videos. I just want to make sure everybody's aware of that. So I'm going to get back into our class in MindTap and just make sure everybody knows that those are there. So every chapter has them. I'll go down to chapter 11. And I just want to make sure everybody knows those video reviews. They're really good. So just make sure you take a look at those too. They kind of walk you through some very specific problems and show you some concepts and stuff like that. Okay, as always, if you have questions, just let me know. Thanks.